Stanley Druckenmiller is widely regarded as the greatest macro trader who ever lived. Born in Pittsburgh in 1953, he grew up in a middle-class family and studied economics and English at Bowdoin College in Maine. After graduating, he went to work as an analyst at Pittsburgh National Bank. At just 28 years old in 1981, he founded Duquesne Capital Management. From 1988 to 2000, he ran George Soros's Quantum Fund, one of the most powerful investment vehicles ever assembled. In 2010, after 30 years of managing outside money, Druckenmiller closed Duquesne to investors, calling it emotionally draining to manage other people's capital. He now runs his wealth as a family office. What he left behind is a record that no professional investor has matched. In September 1992, Druckenmiller and George Soros executed what became known as the trade of the century. Britain was part of the European exchange rate mechanism, a currency peg that required the pound to trade within a tight band against the German Deutschmark. The problem: Britain had joined at too high a rate and its economy was struggling. Unemployment was rising, and the interest rates needed to defend the peg were crushing British businesses and homeowners. Druckenmiller spotted the flaw first and wanted to short £500 million. Soros told him, "If the thesis is right, go for the jugular, bet it all." They built a position of £10 billion short. On September 16, 1992, Black Wednesday, the Bank of England raised interest rates to 15% in a single day trying to defend the currency. It failed. Britain was forced out of the ERM. The Quantum Fund made approximately $1 billion in profit in a single day. Druckenmiller's approach is fundamentally different from stock pickers like Buffett or Lai Lu. He is a global macro investor, meaning he bets on currencies, interest rates, commodities, and equity indices based on macroeconomic themes. His core insight is that the most money is made by identifying major dislocations, moments where the price of something is fundamentally disconnected from its economic reality. But what separates him from other macro traders is position sizing. His exact quote, "The key is not to be right, it is to make the most money when you are right." When Druckenmiller has high conviction, he does not diversify, he concentrates. He has described putting 20% or more of a fund into a single trade on multiple occasions. He also believes deeply in liquidity, only making bets he can exit quickly if the macro environment shifts. This combination of concentrated conviction and rapid reversibility is his edge. The numbers are almost incomprehensible. From 1986 to 2010, a period that included the 1987 crash, the dot-com bubble, September 11th, and the 2008 financial crisis, Druckenmiller never had a single losing year. Not one. His average annual return over that span was approximately 30%. $1,000 invested at Duquesne in 1986 would have grown to approximately $2.4 million by the time he closed the fund in 2010. The same amount in the S&P 500 would have become roughly $12,000. That is 200 times more money than the index. His assets under management grew from $1 million when he founded Duquesne in 1981 to $12 billion at its peak. When he announced closure in 2010, it was one of the most remarkable voluntary exits from the industry in history. Druckenmiller's career is defined by a handful of legendary trades. The British pound short in 1992 earned approximately $1 billion in a day. In 1999, he initially rode the dot-com bubble, returning 40%, but stayed too long and lost $3 billion in 6 weeks as the bubble burst. He has called it the most expensive lesson of his career. He knew the stocks were overvalued but bought them anyway because of momentum. In 2008, he shorted financial stocks ahead of the crisis and generated substantial profits, while most managers were losing 40 to 60%. In 2012, he identified the Bank of Japan's policy shift under Prime Minister Abe before most Western investors and shorted the yen, producing billions in profit. More recently, in 2023, he correctly bet that the Federal Reserve would keep rates high for longer than the market expected, shorting long-duration U.S. Treasuries. And he was an early and large buyer of Nvidia, correctly anticipating the AI infrastructure build-out. Since closing Duquesne to outside investors in 2010, Druckenmiller runs a family office that still files 13F disclosures with the SEC. As of late 2024, his disclosed U.S. equity portfolio is approximately $3 billion. His largest publicly disclosed positions include Nvidia, reflecting his conviction in AI infrastructure, and Coherent Corp., a photonics company critical to data center networking. He holds Philip Morris International as a steady compounder. He has significant positions in NASDAQ 100 call options, signaling continued bullishness on technology leadership. He also holds the gold ETF as a macro hedge against currency debasement, consistent with his long-standing view that central banks are printing too much money. Notably, he cut many of his AI positions in mid-2024 and then re-entered by the third quarter, demonstrating the tactical flexibility that defines his approach. So what can the rest of us learn from Stanley Druckenmiller? First, when the thesis is right, go for the jugular. Do not spread yourself thin. Concentration is how great returns are made. Second, never let a winning trade turn into a losing one. He cuts losers fast and without ego. Third, markets are moved by surprises, not by facts that are already priced in. Ask, what does everyone already believe? That is what the market has already bought. Fourth, liquidity drives asset prices in the short run. When central banks are pumping money in, almost everything goes up. When they tighten, almost everything goes down. Follow the money. Fifth, be willing to change your mind completely and quickly. Druckenmiller reversed entire books of trades when the evidence shifted. Pride has no place in macro investing. Sixth, protecting capital comes first. Great returns over time require avoiding catastrophic losses. And seventh, listen to price action. Markets often know things before analysts do. Subscribe to Stock Talk for more deep dives like this. This video is for educational purposes only and is not financial advice.